Hey guys, Tim Melvin here, and we've got a special kind of a big treat for you today. Something that we don't usually do. We've got a leading technical analyst on today. We usually go with the fundamental guys, but I've been reading Alex Spirgolou's work for a little while now. I've been introduced to it through some mutual friends, and he's doing some ground-breaking work in the area of momentum, trend, and trend reversal that I think, whatever your perspective, whether you're a growth investor, a fundamental momentum investor, or a deep value investor, this work has an extraordinary amount of value. If you're a strictly technical type and this isn't in your toolbox, you're leaving a lot of stuff out. So, Alex, I want to thank you for spending a little bit of time with us today. You're across the pond, so it's getting late in your day. So, you're kind of going the extra mile for us here. So, I appreciate that.
Thank you so much for the invitation and the kind introduction. It will be a pleasure to chat with you and just share the little things I know about markets.
Okay, well, I've read your work. It's actually quite a bit more than a little bit, but let's dive right in. Let's be fair to your time here. Let's talk about your smart system and exactly how you came to develop this really rules based approach to evaluating markets and trade setups. How did you come across all this?
Perfect. Well, the history behind it is that um, when I started out with technical analysis and my journey with technical analysis started in 1995 when I was my last year at university. I'm 52 years old now, so you can see it was quite way back. So I started as a technician, then got certified in as a I got the CFTE and the Diploma in Technical Analysis by the Australian Technical Association. If memory serves around 2000. So basically, I started as a technician, and although I fell in love with technical analysis, literally fell in love. I mean, it was love at first sight, but I never felt that it was complete in the sense that it was answering the what is market moving, and I think it's an absolutely necessary tool for someone to have, but it didn't answer the why.
Mhm.
I mean, why market moved. Some people may not need to have the answer to this question, but I wanted to, and I found that the why is always answered by fundamentals, not so much technicals.
Mhm.
um, so mind you, I'm a futures guy, so I usually trade large asset classes, and so I wanted to find the macros for the macro drivers for these markets.
Mhm.
So over the years, I started isolating factors that I thought were important, either through my own work or reading about other people's work. For
Mhm.
example, Martin Pring, intermarket analysis, John Murphy.
Mhm.
Um, of course, the person that had the most influence on my work was Larry Williams
Okay.
and others as well. So basically, each one had their own perspective. So over the years, I felt firstly I need to find a way to combine macro and technicals, and I usually and I did that through what I call an MTMF framework, which is multiple time frames, multiple factors. So it was this approach, this analytical approach,
Mhm.
was has one foundational premise. If you believe that, then it will have value to you. If not, you can the whole process um, should be ignored.
Hmm.
So the premise is that each time frame has its own return drivers.
Right.
So there are three time frames I watch: monthly, weekly, and daily. So on the monthly chart, I watch the macros, economic statistics, and you can create, of course, a composite indicators of this. Then I go to the weekly chart, which I work. Then I do work on commitment of traders report, sentiment, um, and intermarket analysis, intermarket relationships, intermarket models. Also, I'll check at seasonals, and then I go to the daily chart, which is this is where I do the technical analysis. So I always want to have a fundamental background,
Mhm.
which tells me the why market should go up or down, and then go into the execution framework, which is time frame, which is the daily chart. So then apply the technical. So I always start with fundamentals and then technicals. So this
Okay.
was my first. So this is how it evolved, and at a later stage, it became very important to me to be rules based. A, to manage the information that I had to juggle with, because when you have multiple time frames and multiple factors, there are a lot of things at play. So unless
Right.
you develop a rules-based approach, you will get conflicting signals. You might forget. It will be very difficult. So that's how then it became a rules-based framework, what I call the forest framework. Set up signal, stop, and size. These are the forests that
Right.
basically any trade is comprised of. So once I've created a strategy based on this multiple time frame, multiple factor. So basically every Saturday I go to my weekly charts. I don't do any technicals. What's
Mhm.
the commitment of traders report? What is the data from intermarket analysis, sentiments, and all that. So if I get a bias, long or short, then I go to the technical charts from Monday to Friday. So this is my work. And on
Okay.
Sundays I take a rest. And and then,
Okay.
uh, and then on and then on once I've created the strategy, then I combine, because I try to have multiple strategies. So I can make use of the what someone called it the eighth wonder of the world, which is uh, diversification and compounding.
Mhm.
So through what it's called a core and satellite approach, basically at the core is long-term ETF positions,
Mhm.
again held on the weekly chart, and then I have satellite positions, which is short-term futures trading. So my portfolio is basically a mix of uh, long-term ETF positions, again usually taken on the weekly chart,
Mhm.
with short-term futures trading on the daily chart, which of course has a fundamental background.
Sure. So I could imagine you would find yourself in scenarios here where you're long a particular ETF in the weekly, but short on the very much shorter term futures market because of movements on the different charts.
Yeah, absolutely,
So,
absolutely.
okay. Um, let's talk a little bit about first, if you can share a little bit about which fundamental economic factors you find to be important in your model.
That's a good question. Well, the
I
what
surprised you
I've
with that
my
one. Sorry.
from my observation, there are a lot of economic statistics that play a role in seeing what the economy does. So
Mhm.
basically, what you can see in order to see what the business side does, you can see it from two two points of view. You can observe the business cycle either through economic statistics
Mhm.
or through intermarket analysis, basically the correlations of the various asset classes.
Mhm.
Both John Murphy and Martin Pring have talked a lot about this, especially Martin Pring has created a six-stage business classification model based on the correlations of the asset classes. So to answer your question, what data I'm looking, either through intermarket relationships or economic statistics. Now, when I use the various economic indicators, I don't see them in isolation.
Mhm.
I create composite indicators because things can stop working for some time, and I think it's very dangerous. I mean, I see a lot of people who say, if you a very simple model. If someone plots on a shorter moving average on inflation,
Mhm.
and you can literally create a trading system around it with moving average crossovers for the S&P 500. But I don't, you can all do the same thing with unemployment data.
Mhm.
But I think the best results come when you combine indicators, because sometimes the business cycle will not be that sensitive to a particular
Right.
type of economic data. For example, like inflation, um, everyone fears about inflation that will start picking up.
Mhm.
But if the economy is strong, then um, unemployment data may not be that
Right.
relevant. So I think the best thing is to create a composite indicate, a composite model, if you will, with comprising of various economic indicators.
Okay. Now you mentioned commitment of traders, and I know Larry Williams has done a ton of work on that, and some other folks. This is one of the most ignored and underused tools that's available. When you talk to regular individual traders, nobody's looking at this, and I think, um, and hopefully you agree. I think that's a mistake. How can folks use this? And I know you're going to make some of it available in your new webpage at alexspirgolou.com. By the way, that site, you're a few days away from a full launch on that, I think is the case. But
Absolutely.
you should go check it out and be in the line for when Alex makes the smart system readily available. But talk just a little bit about commitment to traders and what kind of information we can get from that. I believe that still comes out weekly, doesn't it?
Absolutely. It does come weekly. And again, this is something I learned from Larry Williams. It was one of the pieces of the puzzle from on that would answer the question, why is the market moving, up or down?
Mhm.
For example, if there's commercial buying, or if there's commercial selling, or if the funds are buying or selling, and so on and so forth. So it is it is a piece of data that comes weekly. It's freely available to everyone
Mhm.
and measures the positions of the largest traders in futures markets. If you want to simplify it, um, the definition is just analysis of open interest.
Mhm.
And it is completely different open interest than volume, because volume includes, for example, intraday traders.
Right.
But open interest include is just is the people that hold the positions from one day to the next. So they have a more long-term outlook. But participants in futures markets come there with different motives.
Mhm.
Some may be looking to hedge their underlying business.
Mhm.
So, for example, say an airline company like British Airways, and I'm mentioning this because I live in England. So, British Airways. So, for them, the cost of fuel is fuel is for them is a cost, a cost of doing business. But for a an oil company, that's the underlying business of what they're selling. So they have different motives when prices are going up. One is, happy, so because they're selling at a more expensive
Right.
price, so they don't need to hedge it. So the but for an airline company, they need to hedge it so they can make sure there is an analysis of, okay, this is the much revenue we get. We lock in a cost, but so they sell futures against it.
Mhm.
So, or for example, a company that makes like Kellogg's that make cornflakes. So corn, obviously, for them, they participate in corn futures in order to hedge. So you've got these types of traders, which are very big size. They're trading very, very big sizes. So then you also have people, very large traders who are not hedgers; they're speculators,
Mhm.
usually funds. So they can come in, and these traders usually are trend followers. By and large, they're doing trend following. And then you've got the third category, which is small traders, basically the leftovers of the two
Right.
people who don't get classified as large traders. Now, what I've just described is the legacy um, uh, commitment
Right.
of traders report. Now, there is another one called disaggregated, but let's not confuse
Right.
with too much information. So, in a nutshell, what the commitment of traders report does is give you the information of what the big players, the so-called, smart money is doing, not individually but collectively.
Right.
And through that, you can gain an insight of how much conviction, or how long or how short they are in a particular market, be it a currency, commodity, bonds, or even equity index futures.
Yep. And they do break it out by long and short. Whether these guys are long a bunch of contracts or short, you can compare it week to week and see the changes. Correct.
Absolutely. Yeah, you have information for both longs and shorts. You can do long minus short, and then you have the net position, whether it's net long or net short. So if
Mhm.
you see the indicators above zero or below zero, and it's quite impressive because it really does make a causation. So when, for example, markets are falling, commercials are start buying because for them they are it's an opportunity for them to acquire a cost,
Mhm.
sorry, to lower the cost of production for them.
Sure.
So you can see they're quite active. So large traders, from again depends on from each market, but usually commercials are about 60% of the open interest.
Okay.
Again, depends on the market, depends on the time, but by and large, you can see they are the biggest force in the markets. And of course, if you add the large speculators, um, you can see pretty much what the people who move markets, uh,
Right.
how they are positioned. The one quick note. Now, of course, these are very general descriptions because you
Right.
have to look at their participation on a market by market basis. But just to let your audience know what in general commitment of traders report is.
Right. And if memory serves, I think Larry wrote a book about that. That is
Absolutely,
probably available
absolutely.
on Amazon.
Yep,
Um,
yep. Uh,
and then
Um, mhm.
let's get to the big one here. And by the way, everybody, I will pop a link in later on when I get this all dressed up for the site. I'll pop a link into for Larry's book on commitment to traders because and Alex's website at both. But I want to get on to the big one because as you progressed in your career in technical analysis, you realized that there wasn't anything that was doing or providing all the information and signal that you wanted. So, unlike most of us who would just be frustrated by that, you made your own and you wrote a paper about this. You won the Charles Dow Award for Best Paper of the Year, 2023. Is that correct?
2022.
22. Okay, it's off by a year. But your indicator is called the MACD-V, and this is the moving average convergence and divergence oscillator adjusted for volatility.
Absolutely.
Nobody's ever looked at it this way. I've done some work with it, using it from my perspective as a value investor, and I can tell you it strikes me as ridiculously valuable. But let's kind of get into what led you to develop the indicator, how you went through that process, and how this thing works, because I do think it's an incredible value to investors and traders alike.
Well, the story behind it is that up until 2014, I was using, like everyone else, momentum indicators. Um, but when tried to, I was always found myself switching from one indicator to the other because each one had their own plus and minuses, the advantages and disadvantages. So I thought, this is not something, that should be happening, switching from one indicator to the next.
Right.
So I decided to do a deep dive on momentum indicators. So the first thing I did was create a taxonomy of the various types of momentum indicators, so I can start, seeing the differences and studying them in more depth. And what I found was, first of all, that there were like literally hundreds and hundreds of momentum indicators. And
Yes.
I came to my first conclusion is that there were probably more indicators than traders. So, and the second conclusion was that they came in two broad categories. The the first one was range bound and normalized, sort of like the RSI. So
Right.
they go normalized because they have a finite scale. They go from 0 to 100 in this particular case, or the stochastic indicator, or whatever other type of uh, such type of indicator you want to see, and also normalized. So it's range bound because the 0 to 100 scaling
Right.
provides an opportunity to compare across time or across securities, but it's bounded. I mean, it can go to 101.
Right.
So the advantage of this is that they are comparable across time and across securities. So say the 80 level on the RSI is comparable to on the S&P 500, it's comparable to EURFX.
Mhm.
But the problem is that they are range bound, which means in certain particular market environments, for example, when the market is highly trending, the indicator cannot adjust with the momentum of the market.
Right.
So imagine having a speedometer in your car when it can go 0 to 100 miles. But as soon as the car goes 120, your speedometer continues registering a maximum value of 100.
100. Right.
So I wasn't happy with that. The other types of indicator was unbound, which was good, but they were not normalized on their scaling. For example, the MACD indicator can adjust with the trend, and as long as the market is rising with good momentum, it will continue rising, or likewise with declines. but it's an what it's called an absolute price indicator. Well, for very very quickly, the math of it is a short-term moving average minus a long-term moving
Mhm.
average, and that spread, of course, is dependent on the absolute price of the underlying security.
Mhm.
So if you've got a high-priced item, say S&P 500, it will be a moving average of that and a long-term moving average of that. So it will be say a MACD value, just give top of my head, 200.
Mhm.
But if you have a low priced market, sort of, for example, a currency, when it's to 4 or 5 decimal places, the MACD value will be 0.00003.
Yep.
So these two values are not comparable. And for markets that change a lot over time, think the S&P 500 again, due to the upward drift, the values of the indicator are not even comparable across time for the same market. So because there is a much different price value for the S&P 500 just 10 or 15 years ago, the absolute price of the MACD is not relevant across time,
Right.
even across securities. So I was having faced, and first of all, seeing these, these the drawbacks, so the advantages and disadvantages of each category, I thought, okay, maybe we can build an indicator that is, what it's called best of two worlds. So it can be normalized, like the RSI sort of type
Mhm.
indicators, if you will, but also unbound, like the MACD type of indicators.
Okay.
So obviously, because you cannot unbound a normalized indicator,
Sure.
my way of thinking was how I can normalize an unbound indicator instead of trying to unbound a normalized one. So I took the MACD and said, okay, let's take this unbound indicator and try to normalize it. So the first idea I had was normalize it with price. Basically, the formula would be short-term moving average minus a long-term moving average divided over the close of the price. So
Mhm.
basically put that spread between these two moving averages as a function of the underlying price. So basically, we put it in percentage. You multiply it by 100, put percentage. So there would be a MACD percent. So instead of being 80 points, it would be 3% or 5%. Um, so what I found, first of all, was, although I had thought of the idea, I wasn't the first one to think that particular solution. And I think the MACD percent, I think it's usually referred to by PPO, percent price oscillator. Um, so I said, okay, despite I can't claim authorship on that one, but let's see how it works. And interestingly enough, what I found was my first experiment was on the S&P 500. I said it was normalized across time. I said, well, there you go. That solves the problem. And if memory serves, the overbought and oversold levels, I can't remember, six, but it's 4 years since I wrote the paper. I think the overbought and oversold levels for the people for the S&P 500 were 2 or 3%. So
Mhm.
basically, whenever the two moving averages um, diverged by that amount, that was overbought, or minus 2 or 3%, it was oversold. So I
Mhm.
said, okay, fine, that solves the problem. Let's do this on a completely different market. And I checked natural gas.
Mhm.
And lo and behold, again, it was normalized across time. It was basically stationary around the mean. And I thought, that's fantastic. So, what's the overbought and oversold here? That's 7% and minus 7%. So that's
Right.
strange. They have different overbought and oversold levels.
Mhm.
So then I said, okay, let's take on a completely different market asset class. Then I checked the German Bund. And again, I tried the indicator, measure the overbought and oversold levels. It was zero point 0.7 and minus zero point 0.7. Again, it was normalized. But what I found was that each market had its own overbought and oversold levels. So the MACD and been normalized across time, but not across securities. Because, for example, if you wanted to watch uh, follow this indicator across say 500 stocks, the constituents of the S&P 500, you have to do this optimization process and find the overbought and oversold levels 500 times. So that wasn't very useful.
Right.
So my question at this time was, why does this happen? Because since we put this in a percentage basis, a percentage should be comparable for all markets. I mean, whatever in everyday life, what we measure in percentage, this rose 5%, this is 6% more expensive. Um, it puts everything on a common basis, but not in markets. It didn't work that way. So my question then was, why doesn't a percentage-based calculation provide the answer that we need? And I said, maybe because of volatility,
Hmm.
because a market like fixed income, the German Bund, the 10-year Treasury notes, has a lot less volatility than a market like natural gas,
Yeah.
or in today's time, if you can do it something like Bitcoin. And maybe that was the answer. So instead of, through this observation, I decided to replace the denominator of that equation. And I said, instead of normalizing by price, I normalized by volatility. And lo and behold, because each market, each momentum was normalized by its own particular volatility, everything became um, very simple, everything became very clear, and all markets now were comparable both across time and across security. So the overbought, oversold levels were exactly the same for all markets, for all securities. You could be trading the lowest price stock, you could be trading, uh, German DAX, um, core futures. It really, really doesn't matter. Everything was normalized. Plus, you had the advantage that the nature of the MACD indicator being unbound, this could rise as much as could adjust with market. So I found overbought and oversold levels, which is basically 150 and minus 150,
Hmm.
which means that when momentum is 1.5 times its volatility, then you have an overbought and oversold level.
Right.
And that was uniform across all securities. But what I also observed was that the absolute highest value was different for each security, because the market might be going through uh, um, like a buying frenzy,
Sure.
and the indicator might give you a very, very high reading, which could be different for a different market, but it was unbounded.
Hmm.
So that's why I liked it. And that discovery took me about a year, from 2014 when I made the observations, 2015 I made the found the solution. And for my first reaction was a bit, surprised. I mean, it can't be this, this simple, because the MACD has been in existence for almost 40, 50 years now.
Right.
So I thought, come on, someone else must have thought about it before. It can't be, that simple. So I tried to look through literature. I tried to look through books, websites. Uh, there was nothing there. I mean, just, said I made the discovery. So I started using it, and I found created a lot of techniques. I've got 7 core patterns and a lot more which I haven't, disclosed yet. So around 2022, I said, okay, I wanted to share this my work, and I said, okay, instead of me just writing a blog post, let's make it a bit more official. Let's write a paper, a research paper, and then send it to 2 institutions, professional bodies. One was the Chartered Market Technicians Association,
Right.
which has the Charles Dow Award, and also the National Association of Active Investment Managers, which runs the Founders Award,
Hmm.
which basically research competitions. So I said, I'll send it there, see what happens.
All right, and of course you won the Dow Award. We know that for your paper in 2022. It's been very well received. I'm going to put a link to a copy in the remarks section of this, because I do have that here, and it's got the specific overbought and oversold and trending information in it. So now, because I don't want to take up your time, and we're getting
No,
to
please
the.
do. I enjoy this conversation very much. So
Oh,
I think
okay, okay.
I'm doing most of the talking, unfortunately.
That's exactly what I want. Is for you to do most of the talking, because this is your topic. The audience hears me talk all the time. They probably get a little tired of it. So, um, real quick, RSI is one of the most popular indicators. Everybody out there is using RSI just exactly the way you say: over 70, under 30, overbought, oversold. That you've done some things using it that where it gives more valuable readings, especially in relationship to an exponential moving average. So you're doing some cool things with RSI. So can you talk a little bit about that?
Yeah, I mean, there are quite a few techniques I've developed through the RSI. Basically, there is, without going into the math of it, there is a um, what I call the RSI trend proxy.
Mhm.
There is a mathematical relationship that connects exponential moving averages and the RSI. And the formula is whatever the sorry, the look back period of the RSI you're using. Let's say that you use the default uh,
14.
14. If you multiply that, then you have the uh, and you plot that exponential moving average on price. Whenever the RSI crosses the 50 line, which is the center line,
Mhm.
that's exactly mathematical equivalent of price closing crossing the exponential moving average. So by seeing the using the RSI through that the RSI proxy technique, you have both as a trend following tool, a moving
Mhm.
average crossovers above or trend definition, and also use it as a momentum indicator. So that's the trend proxy technique that one can use with the RSI.
Okay. Yeah, I just found that very interesting because I've never heard anybody else just even take the time to figure out that that relationship existed and how you can use it in even in just your day to day. So I thought that was like really valuable. So I wanted to talk about it a little bit. And then this week you sent out something on uh, the volatility valuation index, and you quoted John Bollinger and said that reduced volatility is where trends are born, and high volatility is where they go to die, or something along
Absolutely.
that measure, which is absolutely true. But the VVI, as you discussed, which I know most of our audience is not familiar with, again, because these you're using tools that are not in the everyday language of the retail trading community. But the VVI struck me as like ridiculously useful. So can you kind of cover what that is and how it works and how it measures trend effectiveness a little bit?
Absolutely. Well, first of all, let me make a small note before going to the VVI. Is that I'm a big believer of using one tool for one job, which means first of all you have to define what you want to be monitoring. And sorry,
Mhm.
I have what I call the core four of um, price action, which is trend, sorry,
Okay.
trend, momentum, volatility, and relative strength.
Okay. Yeah. Water there. We've been going for a while there.
Now I've got a bit of a sore throat. It's got nothing to do with the discussion.
Okay.
So so you've got trend, momentum, volatility, and relative strength. So I always believe that you should be using one indicator for each job, not
Not
plot on
10.
a chart like five momentum indicators and three definition trend definition tools. So as far as volatility was concerned, um, obviously the first tool I ever used was the Bollinger Bands and average true
Mhm.
range Keltner channel,
Mhm.
and they're very useful tools, very, and I still use them today. But what struck me as very unusual, if you will, was when John said before, prior to meeting him in 2010, I think, was that do not use the Bollinger Bands as overbought and oversold signals.
Mhm.
I thought that's strange. I mean, if you're about two standard deviations, then that means that the market is overbought. But he was quite right. They shouldn't be treating that as an overbought and oversold. So I thought, okay, I'll keep that in mind. I'll try to find other because sometimes it's a matter of signal strength, not exhaustion. And when I met him sometime in 2010, because the CMT Association was at that time I called MTA was setting up a chapter in London, and John was the one that suggested I uh, try to be the founding chairperson for the chapter. So during our discussion when he was in London, um, he told me something that, of course, I've heard him say in other occasions as well. Because when we discussed about markets and techniques and obviously volatility with with Mr. Volatility himself, he said that volatility is low volatility is where trends are born, and high volatility is where they go to die. And at that time, that I really, that quote stuck with me.
Mhm.
Although I must admit, I didn't know how to use it in terms of creating, quantifying it.
Mhm.
But I said, okay, let's make a note of this because it's very, very important. Although at this time I don't have an understanding of how I should, flesh it out to put it from a principle basis to make it into a tool. And later on in my professional life, I found a couple of ways how to quantify uh, high volatility
Mhm.
and low volatility. I'm not disclosing how, so please excuse me if I found it
Yeah.
a bit vague. But the VVI, the Volatility Valuation Index, was my attempt to exactly flesh out what John said: high and low volatility. So how can I define high volatility? So the that was the how the VVI was created. And when it has certain values, you have trend exhaustion. And when it is below, you see that the market is in a close range, very low volatility, and then you should be trading breakouts. So
Okay.
for high volatility, you usually have mean reversion, and then you have, for low volatility, you have usually breakouts. Now, obviously, it is a very, very valuable tool, but it's not a standalone. It's part of a system, part of methodology. It's not the be all and all, neither momentum nor volatility. I try to combine them everything
Mhm.
together. And when upon applying this indicator, I started studying the properties of volatility. And first of all, it was that it is trend agnostic. I mean, you can have tops with high volatility. You can also have bottoms with high volatility.
Mhm.
Now, that said, some asset classes are more prone to have bottoms with high volatility. The prime example of that would be equities.
Mhm.
Um, if you use an indicator, for example, like the VIX, you see that it has high readings usually associated with bottoms. But the problem with the VIX is, of course, it's for one asset class, and you don't have a VIX on stocks.
Right.
So the VVI also fixed that as well. And the indicator, of course, that what the VVI measures is, of course, high volatility, defines high volatility and low volatility. You can use it across time frames. You can use it across markets, and it's an excellent tool to see trend exhaustion.
Mhm.
Um, in markets, for example, like commodities, they usually top out with high volatility and bottom with low volatility. So it's the opposite of uh, equities. And but again, these are usually generalization of what usually happens. So the way I use the volatility valuation indicator is, as soon as I see it has a high reading, then I check out the MACD. So what is momentum? If it is oversold, and also it should have exhaustion from a volatility point of view. So I'm watching the market. So I'm trying to have um, confirmation from as many uh, independent tools or readings I can. So I can have an oversold market from the MACD. You can have extreme volatility from volatility. That gives me a better chance of seeing a reversal. Now, if you step back and see the weekly chart, and I see commitment of traders, see the commercials buying, so they are also an extreme. So I have a fundamental reason on the
Mhm.
weekly chart, and also see that it's oversold on the daily chart. That increases my probabilities massively. So that's how I use the MACD, the VVI, and everything else as an ecosystem.
Right. And now you're going to be getting into a lot more detail on this when you have your site live, sometime hopefully over the next few weeks.
Absolutely.
Um, but in the interim, you've got an email list where you've been sending some emails out to folks, which I have signed up on, of course, and I recommend that y'all do too until Alex gets the second. You get an email about every couple of days or so, I think is what's happened, or maybe even every day. But you sent one out this past couple of days that I think is important, and it was on the S&P 500. And you said you looked at a monthly chart and you said, hey, this has only gone to this level, the MACD, a handful of times in the past, and every time it's been indicative of a move. Can you talk about that a little bit? Because I looked at that and it goes together with some of the stuff that I look at on the fundamental side, and they line up really well together.
Absolutely. Well, basically, I looked at long-term momentum. Again, because momentum is, has you can see it in various time frames, and because obviously we're talking about the monthly chart, um, it is it won't give readings very often, but when they do, it's usually very important. And I think if memory serves from the chart I sent, usually the last 5 or 6 occasions when the MACD had reached a level above 150, then we usually had the correction. And currently it is above 150. Now, obviously, because we are talking on the monthly chart, it can continue becoming more and more overbought.
Yes. Yes.
And secondly, it's something to use as an alert to go into the daily chart. But I wouldn't, although I created this indicator, and I would like to say, oh, it's the best thing and only thing you need. But I will be the first one to say no. It's part of my repertoire, part of the tools. So
Right.
I would also add, the fundamentals that you are looking and other stuff as well. But it's definitely something that I would not ignore.
Yeah, and the reason it struck out to me is we do look at things like market cap to GDP, which is now at the highest level in a very, very long time. Matter of fact, it might be the highest ever on that one. But the excess yield on the KP ratio is at a level that suggests that not good times ahead, as is the aggregate investor allocation to equities, which is one of the more reliable measures of future market returns, 10-year forward returns. So you've got all these forward return indicators that go, yep, nope, not going to be pretty going forward. Now we've got this indicator suggesting that we are at overbought levels. But I also have to be fair and point out that on the weekly chart, you're just coming off a buy signal on the MACD from our little kerfluffle in Iran back in March. So it is definitely a warning flag. It's not a definitive signal. You could probably get smacked around going short based on it, but it does. You add it to the indicators and you start looking on the shorter term chart, as Alex said. So we've gone 45 minutes. That's more than I told you I would take of your time. And
Nope.
it's
My
been
pleasure.
it's been an absolute pleasure. We're going to put your email, not your email, but your website in the chat. Put a link to Larry's book, a copy of your paper. Um, Sign up for, go check out the website. Don't sign up or try to pay yet because he's not live yet. Okay. But I'm pretty sure he will send you an email when he is. So
Absolutely. Please do sign up for the www.alexspiroglu.com, or send me an email at alex@alexspiroglu.com, and I'll get you on my email list. And the thing is, what I'm trying to do, provide all these indicators as an ecosystem, along with support and a community. I will also have a course which I will give out for free,
mhm.
because I'm a very, very big believer of that information should be free, so people can focus on implementation, not on information, because you give out a wrong emphasis that once you do the magic course, or see the instructions, you can actually implement them. So my business model going forward will be completely different from which customer in the industry, and I will give all of my courses for free, and then let the people who are a bit more interested, a bit more committed, to come for the implementation.
Awesome. Alex, thank you for spending some time with us today.
My
I
pleasure.
really appreciate it. Folks, I have the information in the comment section of this video post that we'll get out today. I hope you found it as useful as I did. Alex, Thank you so much. You're on the cutting edge of technical analysis today. You're doing some research that we're not seeing anywhere else, and you've got information that is just incredibly valuable for the individual retail investor and trader. So thank you for sharing it with us today.
Thank you so much, Tim, for your time. It was lovely to meet you, and we hope we have a beer in person as well.
Absolutely.
Thank you so much.
Thank you.